5, 4, 3, 2, and 1. Hello, everybody, and welcome to another Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options when exiting highly appreciated assets. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets. Each week, we dive into a particular part of the Deferred Sales Trust so you can get more clarity on how it works and why it might be a great fit for you. And today's topic is no exception. We're talking about how to use the Deferred Sales Trust to eliminate the 1031 exchange forever. And here's the key. If you don't know what the problem is, then you might not have a great solution. In fact, a lot of people who are stuck in real estate with the 1031 exchange believe the only way to defer capital gains tax is by using what's called a 1031 exchange. Now, they might know about opportunity zones. They might know about traditional seller carrybacks. A lot of those aren't as flexible. And so they tend to go with the 1031 exchange because they want to maintain the ability to do deals themselves. But guess what? Right now, we believe it's very challenging to do a 1031 because we're seeing a number of things that are converging. We've seen interest rates that have jumped almost doubled, basically doubled in the past year. And we've seen cap rates that have remained relatively close to where they were. Have they adjusted some? Yes, meaning prices have gone down some, but most sellers are not selling because they don't want to trade in a 1031 exchange for a worse debt position. And that debt position being perhaps they're at a fixed rate at 3.5% to 4%, moving to 6.5% to 7%, where cap rates are still perhaps around 5% and 6%. It's just not a great time. And so there's this challenge between, do I do a 1031 exchange versus can I defer the capital gains taxes and sell? And that's what we're going to be talking about today, how to eliminate 1031 exchange forever. With that as well, as you have questions, you can put them into the chat. You can also prepare those. We'll open it up for questions, in particular deal stories that we're doing right now. And so let's start first of all with what is a deferred sales trust. A deferred sales trust is simply a legal contract between an investor and a third-party trust that allows the sale of an investor's real property in exchange for a predetermined future payments, known as installment payments over an agreed period of time. In other words, you as the seller can become a lender instead of just taking the cash and paying all the tax up front. You can slowly pay tax over time. Another way to think about the deferred sales trust is think of it like a delayed tax trust. Think of it kind of like an IRA, kind of like a 401k. In other words, instead of taking and spending it all on personal use now, you can delay gratification, allow the buyer, loan the buyer the money, which allows the buyer allows, in this scenario, the trust is the first buyer to hold the cash, and therefore you can defer the tax. And this tax deferral capital gains tax is somewhere between 25 and 50% of your gain, depending on the depreciation recapture and depending on what state you're in. And the key is if you can take it in installments, you can unlock compound interest, right? You can unlock what you would have paid in tax to earn interest and grow your wealth. Now, there's some key guidelines for a DST. Number one is the minimum viable transaction. You want to make sure you have at least $1 million gain and $1 million net proceeds in order to qualify. In other words, to make this thing make sense. Now, it's not an IRS guideline to qualify for this. It's actually just an ROI that we have found over all the deals we've done over all the years to make it a home run for you to make sure that it scales and it's big enough. And this is key, right? Because if you're looking to invest into real estate with the trust versus a 1031 exchange, if you have a big enough amount of money to invest, this gives you purchasing power. And the neat part about how to do this is once the money is in the trust, let's say you sold a $3 million asset and you deferred $1 million of tax, and let's imagine you had no debt, this money can now be invested into other real estate investments with you or passively, right? And the neat part is you don't have to do this under a strict timeline. And in fact, there's no timing restrictions, and there's no 45-day identification. There's no 180-day close, and there's also no like kind requirement. Although you can still buy property tax deferred by going through the steps of partnering with the trust. And so that's what we focus like a laser on. And really, I think it's the number one foundation of why we started Capital Gains Tax Solutions, to give you that ability. Because in 2008, the market crashed, and I was a multifamily broker at Marcus and Millichap, and I saw the loss of capital for multiple clients and friends and family. Some lost half, some lost everything, because clients had too much debt, not enough liquidity, and had overpaid in the 1031 exchange. And so they kind of ran out of time. It's sort of like the game we played growing up, musical chairs, where we're all running around to try to get that last deal to make sense, or squeezing that last loan from that lender. Well, when all that stopped, it became a big challenge, and those left with too much debt, not enough liquidity or diversification, ended up losing, right? Or having to grind their way out of it over the next 5 years. So the Deferred Sales Trust eliminates the need for the 1031 exchange, because you do not have to put yourself in that poor position. And that's an advantage over the 1031, right? Is timing. And so you're deferring capital gains tax, you're increasing investment options is the next thing, which is really important. And that you can go into liquid investments. You can go into stocks, you can go into mutual funds, index funds, you can go into T-bills, you can go into different investments that have liquidity, which gives you the ability to keep your powder dry for when the real estate market comes back. Or in this scenario, finally gets to realistic pricing. Because guess what? In 2008, the market took about 3 years to get the bottom of the real estate market. In fact, the stock market tends to kind of show where things are going, and the real estate market tends to lag where things have been. So we've seen, even in this year, an increase, I think, of over about 20% of the overall stock market, which means, and the real estate market's maybe still shifting a bit here. We do think that real estate in the next 6 to 12 months is the best buying window if you kind of follow what happened in the 08 crash. Not that we think the 08 crash is happening again right now, but there's some key things with interest rates and how long it takes real estate to finally shift. It's kind of like a big ship that's moving, versus the stock market, which, because it's liquid and it can move quickly, those tend to change faster. But now that we're seeing the rise, maybe perhaps of the stock market, we think we're going to see the correction even more so in real estate. And that's an advantage for you to use the DST, to not have to do a 1031, to sell high, defer tax, wait on the sidelines, maybe even ride the stock market wave back up some, and then be in the position to buy real estate when it makes sense. Because guess what? You can trade +3, typically exit out of investments that are in securities, put them into an LLC to partner with the trust, and go buy more real estate. And so that are two of the reasons that you have an advantage over the 1031. And this is kind of how you would go back into the trust. I'm going to open up for some questions and bring in some of our strategic alliances. We have new Jake Miller, the Jake Carpenter. We have Mike on as well. Jake Miller, I'll start with you. How are we doing today, sir?
Doing wonderful, Brett. Thanks for always having us, and for the great introduction as to what the Deferred Sales Trust is. I think that's always good to open with. A lot of people come here for the first time, and the Deferred Sales Trust is a little bit of a mystery. So understanding what it can do and who it's for is definitely an integral part of these meetings.
Absolutely. And what would you say is the number one, secret, Jake, to how the Deferred Sales Trust can eliminate the 1031 exchange, in your words?
Simply put, you're not taking constructive receipt today, so you don't owe taxes today. What the Deferred Sales Trust does is it just steps between you and the buyer of whatever assets being sold, and it collects the proceeds by which you don't take constructive receipt of, and therefore you don't owe taxes.
Excellent. And if you want to go back into real estate, because if you're doing 1031s, you typically want to be in real estate. You just want to be in it a good time. What's the simplest way to think about how you won't have to use a 1031 again, and what that might look like if you partner with the trust?
Absolutely. So without using a 1031, you are not subject to the 45 days or the 180 days. You're not subject to all of these time frames, and you're not subject to like-kind rules. And so you can come out of perhaps a imminent domain property proceeds, which is a deal on the table right now with Jake Carpenter, and you can go into another real estate deal or a portfolio of real estate deals. It doesn't have to be like kind in nature, but you can sell that thing and do it in the name of the trust so that it's arm's length and you don't take constructive receipt, and then go buy the other thing without having to chop up the proceeds for taxing agencies.
Fantastic. Actually, I'm going to bring in Jay Carpenter because we want to talk about a deal that we closed recently. It was a over $10 million mobile home park portfolio for a client of Jake Carpenter's out of Idaho. And Jake, talk about the ability to not have to do the 1031 for your client, and now our client too, Capital Gains Tax Solutions, and how, the Deferred Sales Trust has helped him to eliminate the 1031 exchange, perhaps forever.
Yeah, that's a powerful thing to discuss, because I was just on a conversation call with someone yesterday, and I happened to throw in not only just the 1031, how it can eliminate the need for 1031 exchange in the future, but it also defers taxes on more than just real estate. It's Bitcoin, individual stocks, any highly appreciated asset, could be even a collector car portfolio. And so I'm going to throw that out there really quick. And then going back to the 1031 exchange is, he wanted to hit pause for a few years. He didn't want to sell and then scramble to figure out where in the world he's going to have to park this money in 45 days, because you have to decide in 45 days and then have to get it closed in 180 days. And he didn't want to go necessarily right back into parks. He didn't want to deal with trash, toilets, tenants, and liability. So he wanted to go on the sideline and some passive stuff. And the cool thing about this, if you're listening, is a lot of these professionals here, these strategic partners from Micah, Jake Miller, Brett Swartz, myself, we worked collectively on that deal. That wasn't, it was primarily a Brett Swartz and Jake Carpenter deal, but all of these professionals can team up. It's kind of like the Justice League, all the superheroes can team up depending on the size and the details that are playing into this specific situation that we're dealing with. We've got a really, really high-powered, well-versed team of professionals here that can work together to make this thing, to make your 1031 exchanges obsolete, give you much more flexibility, better timing. You can diversify both in geography and in asset class, from stock market to real estate. You can time things better. You can partner up with your trust and become active later on, and still use those proceeds tax deferred to pick up opportunities in real estate that you can then work on yourself. So powerful.
Absolutely, Jake. Yeah, very well said. I like to say maybe we're like the A-team, right? We want to bring the best force of expertise and niche focus so that you can have a team to help you grow your wealth. Now, you also might be an entrepreneur person who knows how to grow wealth. Great. Then we can also be the cheering squad on the sidelines, right? Cheering you on. Sometimes we are the offensive lineman making some holes. Sometimes we're the running back running with the ball. Sometimes we are the offensive coordinator looking over, if you're looking at football is coming up. I'm a big 49er fan. The 49ers, I think it's our year. I'm believing that it's our year, and Purdy's back with his arm. It's looking good. That's a little side note there. But yes, the Deferred Sales Trust can eliminate the 1031 exchange and give you back deferring capital gains tax, investment options. Also, it can save a failing 1031 exchange. We want to encourage you to go to capitalgainstaxsolutions.com as well, regardless if the Deferred Sales Trust is your number one option, because we can rescue a failed 1031. We want to make sure you have that backup plan, but you want to make sure you're working with us to make sure everything is properly in place just in case. So go to capitalgainstaxsolutions.com in case you missed your deadline and you're looking for a way to defer that tax instead of taking that lump sum payment up front and paying the tax. Now, let's quickly move over to the disadvantages of the DST, because someone might say, well, Brett, wow, and why would anyone ever do a 1031 ever again if you had the Deferred Sales Trust? And that's a great question. Number one, here's why you would do a 1031. And here's why we still love 1031 exchanges. Number one, you are selling investment real estate and you found a good deal that makes sense. And hopefully that good deal is associated with good debt, or at least a reasonable debt, good or great cash flow and good opportunity for value add. In other words, you found that needle in a haystack, or you found that deal because you have a vast network of opportunities to buy, and the deal just made sense. A question to ask yourself is, would you have bought that deal regardless of the tax? And if the answer is yes, I would have, then that's a great time to 1031, because 1031s are less expensive, definitely less complexity. And if you have it all lined up and you can close on time, wow, they're fantastic. You're going to maintain what's called a stepped up basis, which is great. One of the best ways to grow wealth is to be able to pass it to your heirs and get a stepped up in basis, or at least they do, and they can sell it capital gains tax free at that point. So that's when you would definitely use a 1031 exchange. Now, remember, one of the disadvantages of the 1031, though, is that it doesn't qualify for any other asset type except for investment real estate. So if you are selling a primary home, a business, cryptocurrency, stock, artwork, collectibles, you're faced with only something like a deferred sales trust or something like an opportunity zone, but you do not have the 1031 exchange as an option. And so that's something to consider as well. A lot of our deals are business sales, luxury primary homes, and commercial real estate, as well as crypto is coming back again. We have closed cryptocurrency assets in the past. We're seeing more of those coming back. The next thing would be the disadvantage of the deferred sales trust might be not all depreciation recapture is deferred. So depending if you have what's called debt over basis and or you've taken some accelerated depreciation, it may not all the way qualify to defer 100% of the capital gains tax. And this is where we work together with Jake Carpenter to do what's called Delaware Statutory Trust, a partial 1031, also known as a Delaware 1031, and a deferred sales trust to solve both problems, because not every strategy is going to solve every problem. So if you have debt over basis, we have a way to do a partial Delaware 1031, typically to just replace the debt over basis with typically a lower down payment, around 20%, that will take your debt. Let's take an example of this. In fact, the deal we did with Jake Carpenter or his client, he did have some debt over basis. I think it was somewhere around $500,000 or $600,000. So he had to replace about $500,000 or $600,000 of debt over basis, but he was able to put about a 20% down payment, let's call it $150,000 of equity to replace that debt. And that debt was not in his name. It was with a third party. And he took a small interest into a portfolio of a few properties. And that allowed him to have the debt replacement, which then freed up the rest of the capital to be into the deferred sales trust, which was his ultimate goal, is to be debt-free, to be passive, at least for right now, and as tax efficient as you can be. And so that is the value of the deferred sales trust, coupled with a Delaware statutory trust, and knowing that not every option is going to solve every problem, but combined, typically we can make an amazing outcome for you. If you want to learn more right now, you go to capitalgainstaxsolutions.com. I do want to open it up for questions or comments from any of the amazing guests that are with us today. We've got a few. If you have any questions, go ahead and put it in the chat. But in the meantime, Jake Carpenter, let's talk a little bit about, when somebody might want to be doing this, some of the timing aspects of it to keep in mind. When do we want to be talking and strategizing and planning? Is it ever too early to start strategizing and planning?
That's a good question. It really isn't ever a bad time to start earlier rather than later. We've got some folks that we've met with recently that, they have nothing under contract. They've got a few offers that have woke them up and basically said, hey, these assets may be worth a lot more than we think they are. And we're getting offers in the area of where we're thinking about really selling them. So you can never start too early. The due diligence process is very, very important. We want to make sure you pull in your CPA, your attorney, your real estate broker, anyone that's involved in the decision-making process, because you don't know what you don't know. And the other professionals on your team can sometimes ask questions that bring aspects out that need to be considered for you to make a decision. And so it's really important that we bring those professionals in. We go through and do a thorough due diligence process. to just make sure it is the right strategy for you.
Fantastic. Mike, I want to bring you in here. Talk about just how flexible the investment options are and how kind of creative you can get with things even that maybe someone might not be thinking about, like maybe a business venture or an entrepreneur venture, and some alternative investments outside of even real estate, particularly, or outside of just the stock market.
Right. Yeah. It's really flexible in the fact that, just like you were saying, you don't have to be in like kind the way that you do with a 1031. If you have a best friend that has a business and you want to invest in their business and you want to help them succeed, this gives you that flexibility to do so. If you're wanting to dabble in the stock market, maybe you've only been in real estate and you've never been able to experience the stock market. Maybe you want to try crypto. Maybe you want to try alternative investments where you haven't been able to be a qualified candidate to do that in the past. It really opens up your doors as far as investments go. Now, I didn't want to interrupt you before, but it's really neat as well where you have flexibility when you might have a couple of sales on the horizon. Maybe you have a couple of businesses that you've developed and you want to sell both of those businesses, but they're not going to close at the same time, or you have property that you're selling, and it's really flexible in that way that you can have them kind of trickle in. So
I think that's a great point. And Jake Miller, talk about maybe a current investment opportunity that might be a little bit more outside the box, but providing even better returns, or a sample of that. If you want to just mention, some of the creative, amazing. By the way, Jake Miller is a certified financial planner, and he's also very entrepreneurial, which is a great mix. Jake Carpenter is an investment advisor and also creative with real estate. So it's great to have that diversification within thought and investment opportunities. But Jake, want to mention anything that you have going on right now?
Yeah. So when people talk about biggest returns, sometimes the biggest returns you can receive are essentially from tax savings. That sounds interesting, right? But if you don't have to chop up your asset 20%, 30%, 40%, sometimes 50% to the various taxing agencies, there's an immediate win right there. And that can oftentimes come, in tax savings through deductions, deferrals, or exemptions. The Deferred Sales Trust, by name alone, indicates that it's a deferral strategy. It allows you to reinvest the gross proceeds minus attorney fees rather than minus taxes, which is a great thing. But as far as some current deals that we have on the table that have better than average returns, we have a short-term real estate deal in Texas, which is a fantastic thing. What does that mean? A lot of times when people invest in real estate, they invest for the long haul and they have long-term rental agreements, 1-year agreement, 3-year agreement in the commercial space, what have you. However, the short-term rental contracts that people are doing with like Airbnb and such sometimes make 4 to 10 times more in overall rental income. The thing that most people don't know is that a lot of short-term rental funds don't actually own the real estate. All they own are the long-term leases, and then they sublease. So what we have is a combination of the two, Brett. We own the properties, and the properties, the real estate, the collateral is kind of what backs your shares in the fund. But at the same time, we're getting that higher 4 times or 10 times income from the rents, because we're doing short-term rentals in very friendly neighborhoods where it's actually zoned for short-term rentals. And so that's kind of the nature of that Mars Ventures Fund. That's one of our opportunities for our clients right now. Oh, you're on mute.
Absolutely love that. That gives you the opportunity to diversify, and it can also even diversify within real estate itself, right? Different asset types, different time horizons, higher cash flow for short-term rentals, and in growing places like Texas, right? And so that's the beauty of the Deferred Sales Trust. There's really kind of a couple of different zones we talk about when you're investing. There's the cash flow zone. When you're in the investment, what's the average cash on cash return, right? There's perhaps the other part of the investment that kind of closes the box on this first example, which would be the growth and the opportunity for appreciation. What we like to do is take that and expand it out and say, what are the tax flow zones, meaning how you're coming into the investment and how you're going to exit. And it's taking more of this, I guess, 2 or 3 dimensional approach versus just, hey, your returns are just within the box, cash flow and appreciation. For let's add tax flow And that makes the box bigger, right? It's that much bigger than it would have been if you would just paid tax. And so this tax flow and this cash flow mixed with the appreciation gives you a higher probability of creating and preserving more wealth, and also helps you to be able to be a little more conservative depending on your income needs and your wealth goals with the investments. And I think gives you the biggest thing back, which is time. A lot of business owners love to meet us because they say, look, Brett, my asset is worth 10 million today. After tax, it's 6, right? But with you guys, my number was 10 to retire with my lifestyle. So I can sell today and defer that 4 million of tax. And that gives me back my biggest thing that I love and dear and can never get back, which is time to retire, to spend doing the things that I want to be doing with my family, to giving back, maybe even starting another business or another venture, right? To be able to exit that season of life and unlock some of that freedom, and then also to make an impact for your family. So we want to encourage you to go to capitalgainstaxsolutions.com to learn more about that. You can also connect with Jake Miller or Micah Miller by going to strategictaxsolutions.com and Jake Carpenter, carpentercapital.llc. Just mentioned that you saw or watched this mastermind, and we would love the opportunity to connect with you to see if the DST is a great fit. It's all no cost, no obligation consultation to walk you through and visualize what it could mean for you to use the Deferred Sales Trust. That being said, are there any questions or thoughts? We're going to open it up for everyone here. Could be Jake, could be Micah, could be Jake Carpenter, or anyone else who's listening, who's attending. Questions, thoughts, comments on anything we just talked about?
Brett, what I love about the Deferred Sales Trust is from a corporate asset management standpoint, you can be putting that money to work in the interim in between projects. One of the difficulties that a lot of people have with the 1031, which is just for real estate, right, is that in the interim in between projects, they're not supposed to have a lot of time, and they might get in trouble if they put the proceeds to use in something different. And what do I mean by that? If they have a really good opportunity to do like a bridge loan to a friend of theirs and then jump back into real estate with a deferred sales trust, you can do something like that under normal protocols. You can actually take advantage of lending up hard loans or lending opportunities to other people and their projects and their businesses. You can jump out of real estate and you can jump into a business venture, not just as a hard money lender, but actually shares in their business. You can, hey, right now treasury bills are doing pretty good, so let's put some money there for a minute, and then, hey, my local bank has a great opportunity. Let's do a 6-month thing there, and then, hey, after that, let's go into the stock market, and then afterwards, based on what's good and what's hot, you can react in time, whereas you're not subject to the timing limitations of other government programs like a 1031.
I love that. Yeah. Jake, go ahead.
I'm going to piggyback on that because, I just recently ran into a really good lending opportunity, a very, very short-term lending opportunity that someone can take. Let's say they have $1 million of a tax bill that they would have had to pay. They can take $1 million, go into this lending opportunity for 2 months, maybe 3 months, and make a very competitive return, probably equal to the annual return or more that they would have in a long-term type of investment. And that's like what Jake Miller was saying. It's interim money. It's stuff that's parked on the sidelines in liquid accounts that we just need to deploy. But sometimes people think that if I'm going to be parked in a liquid position, I can't really expect much of a return on that money. And that's not necessarily true when we're really working that money inside the Deferred Sales Trust, especially if it's meant to be dry powder to be deployed in a year or two when the real estate markets are looking, more competitive, their interest rates have come down. So we do have some really, really nice short-term, high-returning lending opportunities in the meantime that we can deploy capital in the Deferred Sales Trust because we don't have to stay locked up in real estate.
Fantastic. Absolutely love that. Great thoughts. Micah, do you have any thoughts, comments, feedback for any of what
I think it would be helpful for folks just to kind of go through a rundown of like what it looks like and kind of what the next steps are, how you meet with the attorneys and how you set up different organizations. I don't know. that might be something that if I were listening to this the first time, I'd say like, well, how do I get started? What's the next thing that I do?
Yeah, let's walk through the step-by-step process. So really step one is scheduling that one-on-one consultation with any of us that are on the phone here. And we walk through if you have an eligible transaction. What that means is basically $1 million net proceeds, $1 million gain. So you can apply by going to capitalgainstaxers.com for that one-on-one consultation. We'll break down what the deferred sales trust could be for you, given your unique fact pattern. As well, we'll start to explore what your main goals and objections are for your wealth plan, and even why you're exiting in the first place, and what you're hoping that the ideal outcome will be in the future. And so we'll spend about 30 minutes or so doing that. Step two would be diving in with the tax attorney and the law firm who created the structure. They provide the lifetime audit defense. This is still a no cost, no obligation consultation with us and with them, where we'll dive a little bit deeper and maybe even do a little bit more of an X-ray or an MRI of your actual sale, how you own the asset, LLC, S Corp, C Corp, partnership, how much debt versus the adjusted basis. It would be great for you to come to the table with, close to the adjusted basis and the debt, and of course the sales price. And with that, we can give you kind of a clear picture of using the DST versus not, which leads into step three, which is engagement agreements. If indeed you say, hey, this looks great, I'd like to have the option to use the deferred sales trust, you'd sign a conditional engagement agreement. And that gives us the opportunity to work with you and your counsel, your brokers, or whoever might be handling the sale, to then weave in the deferred sales trust as an option for you to use. As well, it gives us an opportunity to open up the bank accounts, the investment accounts, and get everything prepared and be ready for close. Now, you might be running, wow, that's a whole lot of work. Am I coming out of a lot of pocket? I don't know if my property is going to sell, my business is going to sell. No, all of that's no cost, no obligation. We just get everything ready for you for any reason. If you didn't want to use the trust or your deal just falls apart for some reason, you're not paying anything unless it closes and you use the trust. And then step four would be actually closing as a part of that as well. We would work with like Jake Carpenter, Jake Miller to do like a financial plan and an allocation. And also with myself to look at some real estate investment opportunities to maybe diversify the overall portfolio. And then you get 24/7 access to the funds online. The funds fund the accounts, and now they're invested, and you schedule a payment back to you with us. Typically, a lot of our clients are taking, let's say, 5 to 6% payout, and the note might be 8 or 9% over a period of time. You might delay that for a little while. You might actually take that immediately in cash flow, and they'll get a 1099 for whatever you received. The tax attorney and us will work with your CPA to make sure everything's properly reported. But after all that's set up, and that's a lot of work and some complexity for sure, but we'll walk with you every step of the way. After all that's set up, it's pretty turnkey at that point. You report it on typically one page with your tax preparer. You get one 1099 every year, and you get a chance to review statements, review the tax returns for the DST, and you slowly pay tax as you receive payments. I'm going to pause there and pass it to Jake Miller to see if he wants to add or subtract or highlight anything I just said.
At the end of the day, you've got a team of professionals here to help guide you and your closest advisors through the process from A all the way down to Z. And a question we commonly get, Brett, what happens after the sale? Well, in lack of better terms, we've just gotten married, so to speak, in the sense that we're here with you till the end. And what does that mean? That means that we're not just here until the deal closes. We're here to help you with the service and the maintenance and the ongoing everything in regards to the trust, along with your other advisors. We work well with other professionals, and we make sure that everybody knows exactly what all of their options are. And I want to say that Brett, with his client portal and everything else, communication is key and incredibly important. And amongst all trustees that are out there, Brett is perhaps one of the best at making sure that clients are in the know and in communication.
Awesome. Thanks so much, Jake. Appreciate that. What else? Anyone else? Thoughts or questions?
Yeah, I think it's important to if you're listening to this, to realize that the clients and the transactions that the professionals on this call that we interact with, they already have their high net worth. They're very, very successful. They have their own CPAs, financial planners, attorneys. We are not trying to compete with your financial planner. So we are not trying to take that role on. We are working in the Deferred Sales Trust. We're working together. We're working alongside of your financial planners, CPAs, attorneys, real estate professionals. So again, we're not trying to replace anyone that's on your existing team. We're trying to increase or be a part of your team and work alongside of them.
Absolutely. But sometimes people do hire us after they spend time with us. And also to that point, sometimes the team that help you get from 0 to $1 million or $1 million to 10 or 10 to 50 are not necessarily the same team to take you to the next season of Invest It. But most of the time we just add to the team, right? So it's not even a replacement. It's just an additional team member to help you with all of these things. So if you want to take action and to get started today, go to capitalgainstaxsolutions.com or strategictaxsolutions.com or Carpenter Capital LLC. You might be wondering, wow, there's so many places to go. Yes, because we're separate entities, Jake Carpenter, Jake Miller, and myself. And that's actually part of the integrity and the transparency with the Deferred Sales Trust is that you do have these professionals that are in each of their niche specialties to help overlook and see and encourage and hold each other accountable and have transparency along with the tax preparer for the DST trust tax return, along with the tax attorney in a firm who sets up the trust and provides the legal defense. We actually think that's a good thing, right? Because each of us has our focus to serve you as the client. You know what? I think we covered quite a bit here. Micah, Jake, or Jake, anything else, or we want to just call that a Friday and wish everyone well?
I think we're good. The only last thing that you could do, Brett, is mention you've got a book out there somewhere.
It's true. And by the way, Jake Miller is in that book. He is one of the most fantastic chapters he has in the book. It's called Building a Capital Gains Tax Exit Plan. In fact, for a little bonus here, since we do have maybe a little bit of time, let's just read a little bit of the wisdom from the Jake Miller as it pertains to the Deferred Sales Trust. I think you are chapter 3, my friend.
Chapter 5.
Chapter 5. Okay. And that's good that you know that. That means he's read the book. By the way, there is a couple books coming your and Micah's way, FYI. And so let's just say that there's this part here that says, he says, I can tell you that not any tax strategy is the right strategy for everyone. For example, for the Deferred Sales Trust, we like to have each person, married couple, to have at least $1 million in some kind of taxable transaction where there's a highly appreciated asset that's been sold or turned over. With that being said, it obviously works, and it's a lot easier to explain when we're talking bigger dollars for those people. And that goes into the exact part that you gotta make sure the dollar amount's big enough so that, in other words, make sure that the pain's big enough to go through the complexities of setting this up and the cost, right? And so there might be people who are going to receive stock options. It works for stock options. And maybe they haven't taken complete control over those options yet, which means we can set it up in time. He goes into more detail about, essentially the story for how he discovered the Deferred Sales Trust and how the Deferred Sales Trust is a game changer. So you can check that out by going to capitalgainstaxsolutions.com or Amazon to get the book. And we also have the Captain Harrington from Shark Tank in the book too, which is pretty cool. So we're proud of the book. Appreciate, Jake, the shout out and the encouragement there. With that being said, take action, share this with somebody. Please rate, review, subscribe to the YouTube channel. Check out the podcast as well. And we will look forward to the opportunity to working with you or one of your clients. Thanks so much. Jake Miller, Micah, you can find them by going to Carpenter Capital LLC for Jake Carpenter, and then Micah and Jake Miller by going to strategictaxsolutions.com. We appreciate everybody, and we'll talk to you again next week. Bye, everybody.